Do you have any idea at this point in time what those wildfires are likely to cost you? Do you have any kind of understanding of getting your arms around the figures?
So first of all, what we know is that they caused quite a number of human victims. We all feel very sorry for this. When it comes to numbers, it's too early to tell. But what we can possibly tell that it's not a small loss. And the market estimates, they're around 10 billion US, some go higher, 12, 13. Exceptional ones go even further than that. So it's pretty uncertain at this point in time. What we know for ourselves is it's certainly a 3-digit million loss on our account. And at this point in time, we would guess that it is in the lower end of the 3-digit million, maybe mid 3-digit million.
Okay. You have stuck to your full-year guidance, 2.1, 2.4 billion in terms of the numbers that you're going to produce this year. The sense was, though, that you're a little bit more cautious now than you were when you were CFO, giving that initial estimate. So talk me through why the caution is now a little bit higher.
Happy to do that. So the CFO, he talked about the first 9 months results. And on that basis, the certainty level that we would probably end up on an expected level in the upper half of that range that we committed to the capital market, that was there. Since then, what has happened is that uncertainty has increased a little bit due to the losses that we cannot possibly accurately quantify at this point in time. Plus, the capital markets look into the equity markets very recently. If we put these uncertainties together, we know, if everything else goes as expected towards the end of the year, that we will end up in the range. And maybe we will end up in the mid of the range. But at this point in time, it would not be conservative, and it would suggest we have certainty if we said it's the upper half of that range.
Sorry, I misspoke there. I don't know why I implied you were the CFO, but that's neither here nor there. That's just my brain.
We don't want to overpromise.
No, okay, fair enough. Let's talk a bit about what's happening in terms of pricing. As you see the pricing environment now, how do you see it going forward? What do you think the renewal story is going to look like in January?
So very broadly, when you look around the globe, then I think what we've seen last year, what we've seen this year, what we would expect for the year ahead is there is pressure on rates because capacity is out there. Capacity is out there both from reinsurers, but also from the alternative markets. That said, there is regions like in the US, due to the losses in Q3, due to the losses wildfire Q4, but maybe also in Japan, that regionally or locally will give reasons to adjust rates upwards. Also in the original markets, if you look into the US, rates are slightly going up. But that doesn't mean that the overcapacity around the globe goes away. So overall, I would say that it is relatively flattish. We don't see a trend downwards. Regionally, there is some reasons for rates up.
What impact? You are massive holders of bonds. Like, you obviously have a sort of mark-to-market effect, and you need to hold those bonds to deal with the future risks that could be out there. We're seeing significant shifts in the bond market right now. The ECB is about to end its QE program. We're already seeing the credit markets beginning to react. You've got turbulence in the European govie market with what's happening with BTPs right now and the turbulence that is being caused there.
Right.
Let's kind of segment it a little bit. What effect do you think is going to be from the ECB ending its program, and how have you kind of got yourself ready for that process?
So we think if the ECB is gonna end up their program, then there will be a very, very gradual interest rate increase development possible only. We don't see a relatively sharp increase. We hope for a slight increase. Are we sure for this to happen really? I'm not sure, but this is betting. I don't know.
So you're not sure the ECB is going to raise interest rates?
I'm not sure it's going to raise interest rates if we talk about 2019, for example. And the reason why is because there is so much uncertainty out there, and you don't know if there is a slight crisis or a slight crash, or there is some political uncertainty around Italy, how the ECB is going to react to that, maybe putting more money into the markets. So I'm slightly optimistic but not bullish about the interest rate increase, and I say that despite the gap between US interest rates and EC interest rates. And how do we prepare for it? Just assuming that this is the scenario going forward.
Okay, it's fascinating that you say that you're not certain the ECB can raise interest rates. Basically, you're saying the ECB
that they will. I'm not saying they can't, but that they will.
But it's basically what you're saying is that they may not be able to do it, or they may not do it during this economic cycle.
Right.
What are you doing with BTPs? What is your position? How do you view the Italian turbulence that we're seeing at the moment?
That is difficult really to assess, I must say. We're observing it. Do we have a better insight than all the other intelligence? Frankly, we don't. So at this point in time, we don't make any major adjustments. We are observing the situation, but also we don't over-assess or overreact to what is really going on in the day-to-day politics in Italy.
Just one final question. Jay Powell's going to be talking in a little while, around an hour and a half's time. How many Fed rate hikes do you think we're going to get? Where do you think treasuries are going?
I personally, I can only refer to what I'm reading out there. Do we have any own further intelligence? I don't know. Do we expect the Fed to go for some more rate hike? We do expect that because this is what they announced. So we're just betting on what. But
is that affecting the way you hold duration?
No.